Hello, Jason Bates here, owner of Electrum Financial, located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you like the lowest rates at the lowest costs, then allow me to put my 30 years of experience to work for you. You've got nothing to lose. Here is this week's mortgage market at a glance. Mortgage rates are based on movement in the bond market, and as of the middle of this past week, bonds had lost a good amount of ground every day for 8 straight days. With that, the average 30-year fixed rate officially hit its highest level in 3 years. That happened on the same day that the Federal Reserve hiked rates for the first time since 2018. But is there a connection? The Fed's relationship with the mortgage rate is quite interesting. The most popular misconception is that the Fed rate hike means higher mortgage rates. But that's not always exactly how it works. In fact, there are many examples of the Fed hiking rates only for mortgage rates to fall. Now, despite the paradoxical reality highlighted in the previous chart, the Fed nonetheless has an extraordinary amount of influence over mortgage rates. One reason we don't see a more immediate correlation is that mortgage rates move every day, whereas the Fed only meets to make rate decisions 8 times a year. The Fed also does a fairly good job of telegraphing probable rate changes. Last week was a prime example, as we all knew the Fed would be raising the Fed funds rate. And that gives mortgage market ample time to adjust to changes in Fed policy before they actually happen. The Fed also has other tools that affect mortgage rates. Most notably, it buys treasuries and mortgage-backed bonds, which are the financial instruments that most directly affect mortgage rates. When it merely signals an end to those buying programs, rates tend to spike rapidly. And by the time changes are actually made, the market has already taken a majority of its lumps. With mortgage rates having risen at an historically rapid pace of 1.25% in 2.5 months, we certainly have taken quite a few of the lumps destined for this particular bout of Fed policy tightening. Whether it's in a true majority remains to be seen, but that's certainly possible. If it feels too early to start thinking about a supportive ceiling in mortgage rates despite the numerous additional Fed rate hikes expected over the course of 2022, consider what the mortgage market has already done to adjust for a less friendly Fed. The following chart, both rectangles are exactly the same. In other words, the current rate spike is already bigger than that seen during 2013's infamous taper tantrum. Now, to be clear, this is by no means guarantees a bounce. The only point is to convey that the bond market does what it can to move in advance of shifts in the Fed policy. I won't really know the extent of that achievement until I see where things actually bounce. Now, beyond that, there are big picture bounces and smaller scale corrections. It's too soon to discuss a big picture bounce, but this week's market movement suggests we're currently in the middle of one of those small scale corrections. This can be seen in the following chart of 10-year Treasury yields, where momentum has shifted from skyrocketing at the beginning of last week to consolidating higher lows and lower highs by the end of the current week. That's the 10-year though, and it hasn't been tracking with mortgage rates as well as it usually does. Shorter-term treasuries, like the 2-year Treasury, have been doing much worse because they're much closer in duration to the Fed funds rate. Fed funds rate applies to money that's borrowed for less than 1 day, and there's much less of a gap between 1 day and 2 years than between 2 years and 10 years. And with that in mind, here's what the market thinks about where the Fed funds rate is going. In other words, this week's Fed announcement helped the market understand that the fallout from the Ukraine war does nothing to slow down the rate hike outlook. If anything, the Fed is concerned it will only add to inflation, thus forcing even faster rate hikes. To reiterate, the Fed funds rate has a bigger impact on shorter-term bonds. 10-year treasuries, on the other hand, are more protected. The following chart shows the gap between 2-year and 10-year treasury yields. The lower the line, the lower the 10s are compared to the 2s. The 2s, 10s curve, or yield curve, is often discussed as a surefire recession indicator when the orange line goes below zero, aka an inverted yield curve. If the current trend continues, it won't be long before the curve inverts again. Well, all I can tell you is that it has generally been this way in the past. I don't really have any great examples of curve inversion in the age of quantitative easing, which is the Fed's big bond buying. As seen in the next chart, 2019 is the only candidate, and we'll never know if that microscopic curve inversion would have brought about a recession because COVID happened a few months later. One thing I can observe about the yield curve is that the size of the inversion does not correlate with the size of the recession. So at the very least, this may be an imperfect predictive tool, but only time will tell. Now, to bring all this esoteric yield curve business back in the world of mortgage rates, it's important to understand that although the 30-year mortgage may technically be able to last 30 years, most don't. The average lifespan tends to operate in a 5 to 10-year range. It's always a bit of a moving target because it's a consumer's choice to move or refinance. Analysts agree that the average lifespan is much shorter than normal right now, and that's not doing mortgage rates any favors. To understand why, just consider the 2-year versus the 10-year concept that I just went over. In that example, the shorter term rate is moving higher, faster than the longer term rate. The same holds true for 5-year treasury yields, which are a much more direct match for the estimated lifespan of a mortgage these days. As such, it's no surprise to see mortgage rates doing better versus 5s than 10s. And the following chart shows the gap between 30-year fixed rates and 5 to 10-year treasury yields. The higher the line, the worse mortgage rates are doing compared to the broader bond market. Now, even when I focus on the 5-year treasury note, mortgage rates are still spiking by comparison. This is a result of multiple factors. Some of them have to do with esoteric bond valuation issues that arise at times of rapid market movement. The simplest factor, however, is that the Fed is no longer buying new MBSs or treasuries, and relative to the total size of the market, the Fed constituted a bigger percentage of guaranteed bond buying demand for mortgages. Lower relative demand equal lower prices and higher yields, aka rates. All other things being equal, of course. Actually, no, even though your gut may be telling you they are. The next chart shows the average 30-year fixed rate versus mortgage-backed security levels. The lower the line, the tighter the lender margins are, in general. Due to increased costs that hit the market after COVID, I wouldn't expect a quick return to the historical baseline. But other than that, margins are as tight as they've been since the start of the pandemic. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, and that is for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice. Until next time, take care and stay safe.